Welcome to Julie Noted. As you may know, over the past few months, 3 of the 4 largest bank collapses in U.S. history occurred. Now, the largest bank collapse occurred back in 2009 during the 2008 and 2009 financial crisis. That was when Washington Mutual Bank collapsed. But again, since 2023, we have seen numbers 2, 3, and 4, largest of all time, follow sway. Number 2 is the Silicon Valley Bank collapse, which occurred in early March. Number 3 was Signature Bank, which collapsed just a few weeks later. And number 4 was the First Republic Bank, which collapsed a few weeks after that and has since been incorporated by JP Morgan Chase. Now, there is always, to put it lightly, fallout when we see major banks collapse, but sometimes it happens in not as obvious ways as we would expect. One of those ways we have actually seen in a recent S&P Global Market Intelligence report, and it is that uninsured deposits at U.S. banks are falling rapidly. Now, uninsured deposits are deposits that are over $250,000. There's this group called the Federal Deposit Insurance Corporation, which is run by the United States government. And what it does is it insures deposits for people like you and me who put our money into banks that are under $250,000. This means that if a bank fails and you have under $250,000 in your bank account, the U.S. government will give you every penny of that money that you deposited. But for people who put in banks over $250,000, that constitutes an uninsured deposit, which means that if a bank collapses, then there is no guarantee that you will get all of your money back. The reason why the FDIC insures deposits under $250,000 is to prevent a bank run from spreading. If people don't have trust in the banking institutions, then really our entire economy falls apart because our banking sector is one of the biggest in our economy. And also, banks enable the rest of the economy to work by handing out loans such as mortgages or car loans so that Americans have the capital to go out and interact in the economy. So what we are seeing here is that uninsured deposits at U.S. banks are falling at record numbers. In fact, the first economic quarter of 2023, that is from the beginning of January to the end of March, saw the biggest quarter-over-quarter drop in uninsured deposits in United States history. As of the end of March of this year, uninsured deposits at U.S. banks fell by almost $600 billion. That is a over $597 billion drop, or a 44.9% drop from December 31st, 2022. Uninsured deposits are also down by 47% from exactly a year before. So from March of 2022 to March of 2023, uninsured deposits have fallen by nearly 50%. Of the 25 banks holding at least $25 billion in deposits or in assets, 20 of them have actually reported a quarter-over-quarter decline in uninsured deposits. And out of the big 4 banks in the United States, that is JP Morgan Chase, Citigroup, Wells Fargo, and Bank of America, only JP Morgan Chase gained uninsured depositors. They only got a 2% boost in those depositors. And many say that it is because First Republic Bank was acquired by JP Morgan Chase. So let's talk about what is causing this and why does it matter that a lot of rich people who have over $250,000 in the bank are rapidly pulling that money out. Let's start with the first question. What is causing this? Well, I mentioned 3 out of the 4 largest bank collapses in U.S. history have occurred over the past few months. To state the obvious, when banks collapse, people have less faith in banks. Shocker, I know. But when they're seeing one after the other, these banks failing, they will not trust that they should put all of their money in one bank. Also, a lot of banks have been plagued by terribly and irresponsibly pursued ESG or environmental social governance policies, which means that the people who run the bank who are supposed to manage customers' deposits are not upholding their fiduciary duty to handle those deposits well and hopefully make some money for their customers, but instead they are funneling a lot of these deposits into ESG style projects. For instance, one of the biggest contributors to the collapse of the Silicon Valley Bank, according to Vivek Ramaswamy, was their huge push for ESG as far as their depositors' investments. Also, just a little tidbit, did you know that 1 out of 12 of the board members of the Silicon Valley Bank, only 1 of those 12, had actual banking experience? The rest of them didn't have banking experience. But the Silicon Valley Bank touted that many of them were women, many were Black, many were LGBTQ, one was actually an improv actor. So the point is, in addition to banks collapsing, we are seeing that a lot of banks are valuing woke policies and bringing woke board members on their leadership instead of actually upholding their fiduciary duty to the people who give their money over to that bank. Also, another contributing factor is that the Fed raised interest rates over the past few months. Now, recently, the Fed elected not to raise interest rates, but given that inflation was at a record 9% just about 9 months ago, the Fed had to hike up each quarter interest rates. When you hike up interest rates, that makes it harder for people to borrow. That means they will not engage as much in the economy. That has a way of cooling down inflation by lowering demand for an increased supply, but it also creates a sense of panic and mistrust in the economy if interest rates are rising. So it makes sense that a lot of people are feeling insecure about where their money is, and they are pulling this money out of the bank. So that is what is causing this. The reason why this is alarming and important to our economic state is that, as I said at the beginning, our banking system is in the top 5 biggest industries in the United States. And unlike other industries, the banking system really is what makes the economy go. As I said, the principal job of banks is to empower, as corny as it sounds, but it's true, empower everyday Americans to go out and engage in the economy. They give them loans so that if they can't afford to buy a house or buy a car or buy other things, they can do that, and that keeps the economy going and going by ensuring that people will seek out products and services. So when people are pulling money out of banks, that makes it harder for banks to give out those loans. If banks are not in turn giving out those loans, then fewer people are going to go out and engage in the economy. And surely, on top of our irresponsible spending and our huge debt, that is probably leading us at a very fast pace to economic downturn. On that happy note, thank you very much for joining me. Please stay subscribed to this channel so that you can see more noteworthy news as well as my timeless episodes. Take care, everyone.